Welcome to the final video of this playlist. If you've missed any of the previous videos, I've included them in the description for you to check them out. I'm glad you made it to the end because this topic focuses on the biggest question when you're finally investing: when to actually sell your shares and rebalance your portfolio. This phase is ongoing for the rest of your investing experience. Everyone is different when it comes to when they want to take profit, whether it's for personal expenses, safety reasons, or simply investing it for a better stock. While my philosophy is to hold your initial investment for long periods of time to get the maximum value, unexpected situations can occur, and some degree of rebalancing is required. My first strategy for taking profit is to sell half of my shares at a 100% gain. This happens when the share price has doubled for your stock. It's a good tactic, especially for speculative investments or companies you're unsure of growing in the future. Selling half of your shares at a 100% gain ensures that you've secured your initial investment in the company. You're letting your profits ride for the long term at no extra risk to you, besides the risk of losing your profit that you made. An example of this is with the company I recently invested in. Ideanomics, ticker symbol IDEX, is a small company providing consulting services for AI and blockchain solutions. Although I like their business model focus, the fintech industry is still relatively young and growing, with no clear indicators of which involved companies will be the main market leaders many years from now. Since I was unsure, but I still wanted to invest in them, I took the opportunity to split my position in half at a 100% gain. I had initially bought my shares around 38 cents, then selling half of my position once the stock price rose to 80 cents, securing my original cash. Now it's nearing $1, and I'm still earning profit on the shares that I still have left in my position. However, for a company you believe in the long term, I would recommend to hold your entire investment if you can, resisting the urge to take profit. Tesla is a company that falls in this category for me. I've been invested in the company for a few years now, and my cost average was around $350 when the shares notoriously skyrocketed, hitting an all-time high at $969 this year. I could have easily secured my profit once my shares doubled, or even panic sold once the shares had started to drop again during the recent market crash. But I didn't touch a single one of them, and I instead look forward to adding more once it fell around my price average. The reason is very simple. I have a much higher price target for the company, and I've done my research to build this confidence. If I've seen the company near a $1,000 valuation, and they're just getting started and disrupting the automotive market, why would I sell now and have the stress of trying to buy back in again? I believe in the company's high growth potential, rather than opting for quick profits in the short term. As the great Nipsey Hussle would say, all money in, no money out. The next strategy focuses on what to do once your stock price is heavily dropped from the price that you bought it at. When it comes to averaging down, this should be done in a very strategic manner to either exit a position or take advantage of an undervalued stock. Setting up a rule for yourself is very important. For example, I like to start adding slowly on losing positions if the stock price manages to trade at 30% or lower than what I originally paid for. If this hits over 50% for some reason due to market conditions and there's not a problem with the company's long-term outlook, I'll double down on my shares to significantly cut the average cost down. I only do this for companies that have good fundamentals and may be undervalued due to facing short-term problems that are causing their shares to be mispriced by the market. Stamps.com is a good example of a company that went from a loser to a significant winner in my portfolio. Last year, they cut their exclusive partnership with USPS, causing the stock to crash from $200 to around $100. Considering a 50% drop, I bought in thinking it was a good deal. The company announced plans to partner with FedEx, UPS, and potentially Amazon for expanding their shipping solution services, making me more confident that the company was undervalued for the long term. But over the span of months after that, the stock kept falling further and further, bottoming around the $30 range, causing even my investment to lose more than 50% in value. While it was a period of difficulty, I continued to average down and buy more shares in the $40 range because I was still confident that the company was excessively oversold. I managed to bring my cost average down to $63, being satisfied with the amount of shares that I was holding. Fast forward to a year later, and the company beat their earnings expectations 2 quarters in a row, skyrocketing the stock to $174, recouping my losses while doubling my investment at the same time. If I had not averaged down, I would have mostly broken even with a bit of profit on the side, but this strategy proved to be a good bet, and it gave good reward for holding a losing position as long as a year. Rebalancing your portfolio is very important so that you can capitalize on undervalued shares and make more use of your time rather than just sitting there and holding a losing position. It allows you to gain knowledge while being in the market instead of trying to time the market itself. Your investment journey will face lots of ups and downs, but the end value of your portfolio many years from now will be dependent on the strategic actions and choices that you make today. So there you have it, the end of this playlist for all the tips and strategies to help you get started with investing. A lot of this comes from my personal experience being in the market, alongside researching what other investors do too. I hope to continue making more content like this, and eventually expanding this channel into detailed videos of companies that I'm buying. If you have any suggestions or topics that you'd want to learn, I'd love to see your feedback in the comments below. Give the video a thumbs up if you enjoyed watching the entire series, as it really helps me gauge the growth of the channel. I do this in my free time alongside my full-time job, and my brother supports with editing while being in college. The videos do require a lot of work when it comes to recording and screenwriting. We really appreciate your time on this channel. Thank you so much, and I wish you the best of luck with investing. Till next time.